The S&P 500 just hit the 98th percentile. And the S&P at this level has historically marked a regime inflection. Something is breaking beneath the surface and the data confirms it. Right now, the S&P 500 is at 7,408.5, the 98th percentile for the past year. Historically, the S&P at this level has historically marked a regime inflection. Says, the data needs to confirm. The commodity analyst says, we are in a commodity supercycle driven by underinvestment and deglobalization. In the next few minutes, I will show you who the data says is right and what it means for your money this month. The scoreboard just changed. When a speaker moves on the scoreboard, it means the data changed, not the opinion. That distinction matters. Score 1 for the commodity analyst. Commodity supercycle. Oil agrees at $105.4. 147-day streak. The volatility expert is right, and the data keeps proving it. VIX at 17.3. 4 days running, the dollar analyst called it dollar milkshake higher. Gold at $4,556 confirms it. McIlroy might be right, but the data has not confirmed the thesis yet. 146-day streak, Hartman is waiting on confirmation. The narrative holds, but the data has not validated it yet. 140-day streak, Gammon just moved from right to wrong. Bad stretch for Gammon, for now. Yield curve at 0.50% says the opposite of credit will blow out. Snyder just moved from right to wrong. Bad stretch for Snyder, for now. Yield curve at 0.50% says the opposite of dollar liquidity crisis. Score today, 3 right, 2 early, 2 wrong. A scoreboard flip means the numbers shifted. Pay attention to what moved and why. Today's big question, are commodities in a supercycle, or is this the top? On one side, says the data needs to confirm. That is the setup. Everyone hears it on the podcasts. It sounds convincing. On the other side, the commodity analyst says, we are in a commodity supercycle driven by underinvestment and deglobalization. Two smart people, opposite conclusions. So who is right? Here is what makes this interesting. Oil is rising while gold is falling. Those two signals should not be going in opposite directions. When they diverge like this, one of them is lying, and the resolution is usually fast. Oil at $105.4, 98th percentile, up 4.2% today. Gold at $4,556, 68th percentile, down 2.6% today. Copper at $6.25, 98th percentile, down 4.8% today. Bottom line, the data is split. Neither side has a clear edge, which means the resolution is coming soon. If oil drops below $80, the supercycle call is in trouble. Right now, it is at $105.4. If copper breaks to new highs while oil falls, it is demand rotation, not a supercycle. Oil at $105.4 is in the 98th percentile, reversal territory. If it drops below the 75th, the thesis weakens fast. Gold at $4,556 will track it daily on the scoreboard. None of the 7 are talking about this next signal, and they should be. High yield spread just dropped 2.1% to 276 basis points. A move this size demands attention. Historically, high yield stress at this level signals institutional risk aversion building. None of the 7 are talking about this. Keep it on your radar. Phase 1 is the good times, but good times do not last forever. Here is how close we are to the edge. We are 74 basis points away from Phase 2, the phase where credit breaks and volatility spikes. There is no acceleration in credit stress yet, but we are watching the pace, not just the level. The trigger, investment grade spread crossing 150 basis points, currently at 76 basis points. Pace is flat or improving. No urgency right now. Phase 1 means risk on is working. Equities, commodities, and real estate all benefit from loose conditions. Enjoy it while it lasts. For context, the last time credit stress built like this, credit spreads blew out and high-yield bonds saw drawdowns of 15%. The credit and rates layer has initial jobless claims, copper-gold ratio flashing red. Gammon says the Fed is breaking things and credit spreads will blow out. The data disagrees with that thesis right now. Phase 1 holds with 74 basis points of buffer. Conditions favor risk, but do not get complacent. Wall Street trades the index. We trade the ground. Here is what the ZIP level data is screaming about today. TX, days on market, is spiking in Borger. Days on market in Borger moved plus 100% in 30 days, now 187 days. Buyer leverage score, 52-100. Days on market is the cleanest leading indicator we have. Big swings mean liquidity is changing fast. OH, days on market is spiking in Canton. Days on market in Canton moved plus 100% in 30 days, now 107 days. Buyer leverage score, 37,100. Days on market is the cleanest leading indicator we have. Big swings mean liquidity is changing fast. New York, NY, payment burden is past the breaking point. New York, NY, median home about $751,000 on about $38,000 household income. Price-to-income ratio, 19.6. When the math stops working, sellers find out before buyers do. These are not hand-picked metros. They are the loudest signals in the housing data right now, chosen by the numbers, not the narrative. Today's debate asked, are commodities in a supercycle, or is this the top? Let me show you what happened the last time we were here. Oil at $105.4 is in the 98th percentile. That means it is higher than 98 out of 100 days in the past year. In 2022, oil spiked above 120, then demand destruction pulled it back 40% in months. In 2020, oil went negative for the first time in history as demand collapsed. In 2018, oil dropped 40% in Q4 as growth fears overtook supply concerns. Different environments, different catalysts, but every time, the resolution came fast. The pattern is not the level, it is the speed of the move once it starts. Meanwhile, copper at $6.25 is in the 98th percentile. The last time both oil and copper were at these levels simultaneously, the resolution came within weeks. That is why the scoreboard matters. It tells you which speakers saw it coming and which ones missed it. History does not pick a winner here, but it does say the resolution is coming soon. Be positioned before it arrives. Here's what the data says to do right now. Stay alert on VIX. It is dropping 3.4% today. Fast moves demand attention. Avoid Phoenix at 41% payment burden. That is stretch territory. Watch high yield spread. It dropped 2.1% and nobody is talking about it. Every signal is live at analyze.builderslens.com. 7 speakers, 65 signals, 1 question every morning. Who is right? Subscribe and I will see you tomorrow morning.